Labour's proposals for tax. In this video, I want to look at Labour's proposals, particularly for capital tax and for pensions. I want to look at these because at the moment Labour are ahead in the opinion polls, and by this time next year, by April, May 2024, we're likely to be in a pre-general election, although of course it's not due to the end of 2024 by law, but it's quite expected to be in the spring. So if that's the case, we've got to get a year and a bit to get our house in order and take advantage of the laws as they are now in case they change and get worse. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel. If you press the like button, it helps me and it helps the channel, so thank you for that. So the taxes that I want to look at, I want to look at the pensions, I want to look at capital gains tax, and I want to look at inheritance tax, because those are the taxes that it's been rumoured that Labour want to change. So let's look at capital gains tax. Well, I think it's quite likely they'll change capital gains tax because Chancellors always change capital gains tax when there's an incoming government. Very often they change capital gains tax because it's not a very big tax, it doesn't affect very many people, so they can. A Chancellor is a bit like dogs, and it's a way for the Chancellor to leave his mark. So the capital gains tax is the lamppost of taxes for Chancellor. That's a little insight into the way my brain works anyway. So moving swiftly on. So what we must remember about the capital gains tax regime at the moment is actually the tax is quite low by historical standards. The main rate is 20%, whereas traditionally it's actually been 40%. So increasing that would be something that would be in character for a Labour government, and I think that's something that we might be looking at. It doesn't affect a huge number of people, but if you've got pregnant gains and you will need to sell assets at some stage in the future, you might be wanting to think about the crystallising of the current rates so that you take advantage of the lower rates just in case they go higher. There is a higher rate of tax for properties, but that doesn't mean that it won't go higher still. And properties can't be sold just once you know that there's an election victory by Labour. You need to do it in advance because it takes months, several months, to sell a property. So if you are going to have to sell a property or want to sell a property in the next few years, might want to just bring that forward and take advantage of the rates as they are now, just in case they go up, because it just doesn't feel like they're going to go down anytime soon. So that's, I think, probably one of the more important things that you could do to make sure that you can take advantage of the rules as they are now. I think the other thing on capital gains tax, which we sort of used to do more on, is that it is the case that there's no indexation for capital gains tax. So if there's no indexation, most of the gains that you have are actually just inflation. So the government creates the inflation, and then there's a capital gain, and then they tax you on the gain. So it's not fair, but it is the rules. So what you need to do to avoid that is just when you buy an asset, just think that you're going to have it for a very long time and not speculate so much. So because if you own it for a very long time, you just don't pay the capital gains tax because the capital gains tax is only paid on sale. And the big thing that you can use to avoid capital gains tax is to die with it, because when you die, then it gets subject to inheritance tax, but the capital gains are washed away. So on that cheery note, let's talk about inheritance tax. And of course, inheritance tax is actually when you die. But let's talk about it anyway. What they're talking about is reducing the allowance. So at the moment, a couple can overall leave £1 million if you add it all up. They can give the house to their children, and they can each leave £325,000. Although those figures have been actually fixed for more than a decade now, that is a substantial amount, and Labour are talking about reducing that somewhat. Well, if they reduce it, that means that more estates will come into tax, and it means that more tax will be paid. But actually it's less bad than completely changing it, which they could do, because they could make it a tax at the point of gift, even in lifetime. They could therefore get rid of the 7-year rule, where gifts after 7 years are no longer subject to within your estate for inheritance tax. Or they could stop business property relief, where you give business assets to your descendants, and then they're not subject to tax. In a way, if they just reduce the allowances, it's if that's all they do, we can sort of live with that. But they might make a root and branch change of inheritance tax. So I think If you are worried and want to reduce your your inheritance tax potential burden, then I think the time to plan is over the next year and a bit, so that you know that you can withstand, you've done what you want and you can withstand any changes to the tax law. So inheritance tax, I think, it's completely in character for Labour to increase inheritance taxes. So if it's worry to you, then maybe think about making some changes and doing the transactions reasonably soon. The other thing I just want to talk about, pensions. So pensions, there were new rules. They got rid of the lifetime allowance, or the lifetime value of your pension. It doesn't matter what's in your pension now, it's total capital value. And they increase the amount that you can put in each month, in each year. That's good, but since your pensions you want to last for 30, 40, who knows, if you're younger than me, quite a lot longer. We care about what the it should be really a political consensus pensions, because you don't want them changing every time there's a change in government. But the lifetime allowance, it does look like Labour want to restrict that, although they're also saying they don't want doctors to be taxed on their pensions. So they need to pick a lane, because doctors, senior civil servants, politicians are the people who are most affected by the lifetime allowance on the pension. So which is it? Unless they're going to make special rules just for doctors and senior politicians, like they have, it turns out, for judges, if they're going to do that, that's really dystopian, I think, having special rules for special people that we particularly like, and not taxing everybody the same. I think that's really dystopian. I think it's more like Atlas Shrugged than 1984, but if you're arguing about the nuances of which dystopian novel it's most like, I think you're in a lot of trouble. So hopefully the grown-ups will come up with some sensible rules, but before you trundle too much money into your pensions, I think we need to wait and see what they are actually intending to do. So there we are. We've talked about inheritance tax, we've talked about capital gains tax, touched on pensions, and I'll keep you up to date as time goes by and as the rules and proposals become more concrete. Thank you for watching. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel. Thank you for coming this far. If you press the like button, it helps me and the channel. Thank you.